I'm going to bring in Main Street Asset Management CIO Aaron Gibbs. Aaron, let me go back to this first table here because, I mean, this is the way. Not a lot of people are in this market since 1998. So if you're in the market, you just got in since 1998, and this has been a norm. This is easy to work off. Okay, I want to hedge. More stocks are down. I'll load up on bonds. It's not working right now.
Well, part of that, and since we've talked more recently, is part of this inversion that we've been talking about for so long, is that we have seen, when you're looking at the total bond market, there is a big difference between your short duration bonds, like your 1 to 2 years, 3 years, versus your 10, 20, 30, where most of the money is. So most of the money is in the 10-year, and that's what's really causing all of this very different behavior and unpredictability, and where do I invest because everything's going down type of days.
So, is it an anomaly? I mean, when your clients call you, because obviously you have a lot of folks who are in the 60-40 portfolio, we should also mention that so far, bonds are down for the year.
Yep.
This will be the first time in history, 3 years in a row, bonds are down. This was a safe bet. This is the bet that a lot of retirees are putting their money on, people close to retirement. So everyone is kind of really nervous about this. What are you telling them? Are we back to pre-1998 or just an anomaly?
I think this is pre-1998 as long as we see the Fed being hawkish and saying they're going to raise rates, because when we're looking specifically at longer term rates like your 10 years, your 20 years, those rates keep going higher, which means the bond prices go down.
Right.
And so until we see yields coming down, you're going to see that big price differentiation.
So let's talk about what you're doing then as a way of, you still like energy?
Still like energy. It's one of your safer. If you're going to be in stocks and we have to reevaluate equity risk premium, that's one of the options. Short duration bonds is another, is getting
Up to
away.
How long? 1 year, 2 years?
5 years, absolute maximum.
Okay.
So there's some great ETFs that are like 1 to 3 years, where you just don't get that big price movement and you just get the yield. Because that's the problem as you get into these bond ETFs. Yeah, maybe you make 5%, but the price is going down, so no good. So short duration, you get a nice stable price, but you still get maybe your 2-3%.
And before you go, there's a stock that you find intriguing here.
Yeah, so I get a question about this. This is one of like the big winners of the year.
The fat miracle drug.
The fat miracle drug, yes, part of the Ozempic trade. And actually, Novo Nordisk, even though it is trading very expensively, it's trading about 35 times forward earnings, it's actually much cheaper than the American Eli Lilly.
Right.
So this is a Danish company,
so you got this big gap.
Yeah,
we got up there.
Big gap.
This pullback here, you're saying, use this pullback as an opportunity to buy this stock on weakness.
So I would say, look, if you really want to get into then, and then look, the earnings potentials and the growth does look phenomenal. Supply chain issues seem to be resolved. This might be that entry point if you want to get
It's absolutely amazing.
Yep.
I did a piece on this about 2 or 3 weeks ago. The side effects, I mean, we're talking kidney failure, liver failure. It's like, hey, in America, we don't care. If we can eat and be slim, are you kidding me? And by the way, have you looked at their economy because of this? You take this out and the economy is flat.
Exactly. This is driving Denmark right now.
So essentially, you're making a bet that Americans are going to keep eating, keep getting fat, and need a miracle drug.
And as long as they keep having the, being able to produce it, supply chain issues are out of it, I think this can continue.
In the meantime, just wait this whole other thing, this market malaise thing, just wait it out.
Exactly. Until we really understand where these bond yields are going, because it has been a sharp rise, you've got to sort of reset.
Right.
And I think for at least the next 2 to 3 weeks, we're going to have a reset. It's going to be very risky, and I'd be very careful about any new positions right now.
Aaron, thank you very much. Always appreciate it. Hey, folks.